Hey everybody, it's Matt from Interactive Accountants, and today's video is going to be talking a little bit about business structure tips for tax efficiency. The first industry that we're going to speak about is law firms. So law firms can be either one or two partners or multiple partners. And depending on how many partners you have is generally going to determine what's going to be best for tax efficiency, believe it or not. One thing that holds true, whether you're a partnership or a single member LLC or whatever it may be, is that when you're a law firm, you want to choose the cash basis of accounting if possible. So your law firm generally has to be making less than $25 million a year in annual revenues to be eligible for that, which with Interactive Accountants, that's most of the law firms we work with. And by doing the cash basis of accounting, you have some tax efficiency because, generally speaking, your receivables are much higher than your payables. In those types of circumstances, you always want to be on the cash basis of accounting, my personal opinion. The second thing that we have to talk about with tax structure is, am I going to be taxed as a partnership? Or am I going to be taxed perhaps as a Schedule C? Or maybe I want to go S-Corp? And that's a great question to debate here. So for law firms, when you've got multiple partners, like more than five, generally speaking, it's going to be taxed as a partnership because it's really hard to have disparity between partners that maybe you've got one earning $1 million and another one earning 200,000, and trying to level that out with an S-Corp is really hard. Partnerships will allow you to have, perhaps you all own a third of the firm or 1/5 of the firm, but one partner is making $1 million and another partner is earning 200,000. So by using a partnership as a tax methodology for your tax return, you can have that disparity. So that generally works well when you have that type of multiple partner situation with partners earning different types of income levels. If you have a one partner firm, a one owner firm, or maybe it's a two owner firm and everybody's working hard and, we're not really worried about who is bringing in what client. We're just, we share everything 50-50. Or if it's just one owner, then S-Corp is probably going to be the way to go, especially if you've got paralegals or some support staff working for you that are making you money, right? So S-Corp will allow you to take a reasonable compensation and then allow whatever profits from the firm occur to pass through to you on a K-1, and those won't be subject to self-employment taxes. If you're just a sole proprietor, it's just you've got no support or anything else like that, and maybe you're looking to keep costs down, then you can file a Schedule C. Okay, and generally speaking, that's for law firms that are going to be doing less than 250,000 a year in annual revenue. Keeps things simple. So that's tax structure simplified for law firms. Now, if we're talking an e-commerce business, generally speaking, those are going to be LLCs and that are going to make an S election if possible. Well, sometimes you can't make an S election because you got a foreign owner, right? But generally speaking, LLC structure, taxed as an S-Corp, reasonable compensation for the owner, and then there's going to be profits from selling products, so you can allow those profits to flow through on a K-1. And once again, the K-1 from an S-Corp isn't subject to Social Security and Medicare taxes. If you're an Amazon DSP, it's a no-brainer. S-Corp is the way to go. You've got reasonable comp that you could take as the owner, and you're making money off of all of your DAs as well as your dispatchers, your fleet managers, your ops managers. Everybody's working to help you make money. So no issues there with passing through earnings on a K-1 to you and saving that Social Security and Medicare tax. Now, if you're a restaurant, generally speaking, a restaurant is going to have more payables than receivables, right? So whether you're a partnership or taxing as a C-Corp because you got foreign owners, or you can do an S-Corp election, you're going to want to make sure that you're choosing the accrual basis for your accounting. And that will give you the best tax strategy because like I said, generally speaking, a restaurant, they got lots of payables and zero receivables. So you want to make sure that you can capture those payables at the end of the year in your tax return and have those reflected as a tax deduction. Right? S-Corp, probably a good way to go as well. The owners, if they're working in the restaurant, can take a reasonable compensation. If they're not working in the restaurant and they're just an investor, then even better. They're just going to get their K-1, not subject to Social Security or Medicare. Whether it's a partnership though, or C-Corp, or the S-Corp, if you're a restaurant, you want to be on that accrual basis of accounting. And that also goes for DSPs as well, because they've got a lot of payables and barely any receivables, because Amazon's paying usually within like 5 days. You know? So no receivables, high payables, that's always going to be accrual basis. Now, if we're talking about a healthcare profession, right? Normally, those individuals are in a situation where receivables, being like their billings to the insurance companies, those sort of things, are much higher than their payables. So, generally speaking, healthcare professionals are going to want to be on a cash basis of accounting. They'll pull out as many expenses as they can before the end of the year and try to lower their tax bite that way. Of course, there's other ways to do it. We have our CTO program for that. But just speaking generally, cash basis of accounting for a healthcare professional, lawyers, even accountants, right? Generally, our receivables are higher than our payables. So we want to be cash basis. And where possible, if we can do it, we want to be S-Corp. The only thing that doesn't really work well with S-Corps is if you own real estate. And why do I say that? Well, there's a couple of things to take in consideration. If you are just selling your real estate that you own in an S-Corp to a trust that you've created, right? Well, believe it or not, you're going to have to record a capital gain on an asset that you're selling to yourself. I know, it's crazy, but those are the rules with S-Corps. With a partnership, if the real estate is owned by a partnership, you could transfer that asset to a trust tax-free. And that's why when we're talking about real estate, you're going to want to be treated as a partnership wherever possible, or a single member LLC filing a Schedule E on a personal tax return. So those are just a couple of notes today on how to best structure your legal entity when it comes to tax purposes. Now, these are all generalizations, right? Situations could be different. Maybe there's a healthcare professional that has a lot more payables than receivables. It could happen. So each scenario is different. And at Interactive Accountants, we take each scenario and look at it on an individualized basis and make the best suggestion possible based on your personal circumstances. So please feel free to reach out to us. My email address is matt@interactiveaccountants.com or matt@ia.tax if you want to keep it short and sweet. Or you can reach out to us on the phone, the old-fashioned way, 305-517-3977. We're happy to help. Thanks, everybody.